Okay, so I'm just sharing my screen with you. Hopefully you will be able to all see that now. So welcome to the Client Review Workshop 2019 for our planning clients. Apologies for the late start and the technical issues, but we will dive straight in. Now, for those of you that haven't attended the Client Review Workshop before, this was born out of I suppose two things really. One was wanting, as part of our ongoing review service for our clients, we wanted to give more and more value, but also as we grew as a business, that became more and more challenging. But a combination of that and the fact that as we grew as a business, we became smarter and we had a more centralized investment approach. And what that meant was, in fact, we found that we were repeating the same message time and again to our clients in the review meetings. So we decided, I think 3 years ago, to split the review process in two. So to do the stuff that applies to all clients that are on our centralized investment approach, which is currently managed by Portfolio Metrics, to do all of that in a workshop format, cover all of the legislation changes, planning opportunities, market updates, all of that sort of stuff, because that's the stuff that applies to nearly everybody in our client base. And then we still do the one-to-one meeting with the advisor. So this is not aimed to replace that. It's there to complement it and allow you to get more value in a more efficient way. So let's dive straight in. Now, for those of you that have registered for the event and are watching it live, we've already sent you with your review pack a copy of the 5 AM Club by Robin Sharma. This is, I read this book over the summer. And if I'm honest, when I started reading it, I didn't think I was going to enjoy it. I read a lot of business books and a lot of personal development books, but I'm not a big fan of books that are written in as a parable. I'm a left brain thinker and I like cold hard facts, and this is what I did and this is what worked, and that sort of stuff works better for me. But the principles within this book are all woven into a story. And as I said, the first couple of chapters, I wasn't really convinced by it. But as I got further into it, I realized that yes, the story was a bit average, but the principles within this book were so amazing that I just couldn't put it down. And in fact, it's the first time I've ever got to the end of a book and said, right, within the next 3 months, I need to read this again. And I'm actually halfway through it a second time in the space of 3 months because there were so many amazing messages in it. So I hope you enjoy it. If you don't, if it for whatever reason it isn't your thing, please feel free to give it on to pass it on to somebody that you think is. If you're watching this webinar recorded, then if you'd like a copy of the 5 AM Club, please just email your client relationship manager and we'll get one in the post for you. It'll also help us know who is or isn't watching the webinar recording. Anyway, I hope you enjoy it. This photo, by the way, was as a result of me being part of the 5 AM Club. It was at my run at Rutland Water last week, and that's one of the benefits of being part of the 5 AM Club. But even if you don't want to get up at 5 AM, there's so much brilliant advice in this book, so I hope you enjoy it, and it's our gift to you as part of the Client Review Workshop. So let's move on. So a bit of an update on what's going on with Efficient Portfolio. Well, we continue to grow as a business. Last year, we moved into our new Oakham offices, and we've been flourishing as a result of that. The team has grown some more, and I'm going to come on to that in a second. Last year, our new business levels were up 30%, which is amazing. And this year, we're looking like it'll be a similar sort of year. The year before that, it was 50%. So we continue to grow really strongly, and we'd like to thank you for your part in that process. We have a number of client relationship managers in the business, and I'll explain why there's actually 6 on this chart, on this page, but there should only really be 4. So client relationship managers that have been there the longest are Katie and Molly. But Katie and Molly have both taken passed sufficient exams now that they actually meet the qualification level to be a financial advisor. Now, that doesn't mean that we let them go out and give advice yet. We require them to spend at least 2 years doing para planning, which is where they write the efficient financial plans for the clients. But as a result, those Katie and Molly have been promoted to para planners, and as a result, we have Charlie and Harry who've been promoted to client relationship managers. I'll point out where in your pack you can be absolutely clear which client relationship manager you should deal with. but it's always used to put a face to a name. So hopefully that helps that process. We currently have 5 financial planners. We've got Tim, Tom, and myself that are predominantly based out of the Rutland office. I obviously cover London as well. Henry is based out of our London and our Oxford office, and Richard is based out of Leicester. We have 2 mortgage advisors, so just in case you weren't aware that we have a mortgage element to the business. Eric, with over 20 years of mortgage advice experience, and Dan, the young protege, is kind of trying to drag it into the modern financial planning world. So if you or anybody you know needs help with mortgages, then please don't hesitate to get in contact with us. Okay, so we've sent you your client review pack. Hopefully you've got that, and it would be useful if you have that open while you're watching this webinar, so that you can look at your own charts in tandem with me showing you charts that actually, whilst they're not specific to any client, they date back as far as we can go in most instances. So it all is, I'm showing you genuine investment data, genuine performance data, and that's really useful, particularly where you've been invested for less than 3 years. If you've been invested for less than 3 years, the investment performance data that you've got in your pack is pretty much meaningless, because anything less than 3 years exaggerates the peaks and the troughs too much. You get too excited by great growth and you get too worried by negative growth. So if you've got less than 3 years investment performance, it's really important that you look at the charts that I show you in more detail than the ones that you've got, because they'll give you a better reflection of what the likely returns what the returns have been. So in your pack, your main review document, you can follow it through. The first page is really straightforward in that we've got a list of your investments outside of pensions. A few things to be aware of. You'll have your performance over here, the value over here, this year and last year. It's worth making a mental note as we look at this now of what your risk score is currently, because I'm going to refer to that throughout the webinar. Up in this top left-hand corner, you've got your client, your one-to-one advisor, the financial planner at Efficient Portfolio that's going to be responsible for looking after you in your one-to-one meetings, and also your client relationship manager. And then down here, you've also got your ISA allowances for the year. So that I'm going to come on to the importance of that later on, but it's just worth having a mental reference of how much of this year's ISA you've used up. Then we come on to the pensions. Same approach, value, risk score, money in, money out. What you'll also have on this page is a total portfolio valuation. And underneath here, you'll have a review of your platform. Now, typically we use WealthTime, Premium or Transact for different client scenarios, and we're really happy with each of those platforms for each of their different specific situations. So we've not made any recommendations to change the platforms at the moment, but that's kind of detailed down there. A couple more pages that look fairly similar. One is then listing any protection that you've got, any life insurance, any income protection, those sorts of things. And what we've also got on this page is a column to show you the cost of replacing that today. If the new policy was cheaper, then what we would do later on in the recommendation section is suggest that you change it subject to no change in health. If it's green, it's cheaper. If it's red, it's more expensive. So it's just worth bearing that in mind. And then the last page of this sort of type is a list of all the estate planning we've done for you. Things like the beneficiary protection trust, asset preservation trust for your pension, assurance trust, wills, lasting powers of attorney, all of those sorts of things will be listed there. So what's going on in the market? Well, it's worth just summarizing what's going on out there, because of course these things impact your investments. And the best way to take a kind of look at that is what's going on in the different areas that you can invest in within your portfolio. So the different areas being things like UK stocks and shares, European stocks and shares, emerging market bonds, corporate bonds, government bonds, those sorts of things. And what this chart shows you is what they performed, what each of those areas performed like in 2018, 2019 so far, and the last quarter of 2019. And bearing in mind, because we haven't got to the end of quarter 3, This is Q2 data. So what you can see is that in 2018, nearly everything was down. But in 2019, up to the end of Q2, pretty much everything was up. And in fact, actually, Q2 was a very positive quarter. When we get to the end of Q2, it won't look perhaps quite as rosy as this, but obviously there's a bit of time left for that to continue. But we're certainly, we've had a good year so far this year, bad year last year. So that's worth just bearing in mind and it gives us context as to what we're going to see from an investment performance going forward. You know, if everything has been down, you can expect your portfolio to be down. If everything's been up, you can expect your portfolio to be up. And if it's a mixture, as it most commonly will be, then you can, obviously be a little bit surprised by what you get. So this chart just very quickly shows us what's been going on with the world market, the FTSE 100 and the emerging markets, and of course the fixed interest elements. But what is happening out there? Well, obviously we all know that Brexit is a key factor. Actually, whilst it's a key factor for the UK and is a key factor for Europe, it probably, with regards to your portfolios, it probably doesn't have quite as much impact as you might expect. Regardless of what happens with Brexit, it's unlikely to tip the world's economy into recession because certainly from the UK, we're not a big enough economy. Because you've got very diversified portfolios, that means that actually it's unlikely to have the biggest impact on your portfolio. And ironically, if we have a hard Brexit, you may actually see your portfolio do better because what we'll probably see is a fall in sterling, and that means that the value of overseas investments and also many companies in the FTSE 100 actually goes up. If on the flip side we get no Brexit or a very soft Brexit, then we'll probably see sterling strengthen, but we'll probably also see more confidence in the market. And as a result, that may well lead to more growth. So Brexit actually isn't the biggest issue, albeit it feels like it probably should be. Obviously, we've got the crazy guy over the pond to consider, and actually the US market has done extremely well. Probably better than anybody expected, but what it means is it looks very overpriced at the moment. If you look at a number of different metrics, and in fact, one that was written about recently was what's called an inverted yield curve. I won't bore you with the detail, but it's a fairly reliable predictor of recession in the US. And so there's a number of things pointing to the fact that the US is overvalued and is potentially ready for some very slow years or maybe even a recession. So that's just something to bear in mind, particularly when we talk about this later on. With regards to how portfolio metrics are positioning the portfolios, they've been underweight US for about a year, which has actually meant that they've probably missed out on a bit of performance. But if they've called the right strategy early, then that will protect the portfolios were the US to go into recession. We then, of course, have Europe. Europe is struggling in many ways, and we're expecting a financial stimulus at the end of this month from ECB. And I think the key here is the fact that Germany looks like it's on the brink of recession, and we've obviously seen Italy struggling, and many other parts of the EU are not growing as well as they should be, and so there are concerns about Europe. But probably the biggest risk to the portfolios is actually the trade wars, this battle between the US and China. And just to show you the impact of that, we saw the FTSE fall from 7,500 to 7,000 at the start of August, just because of a tweet from Donald Trump saying he was going to increase the amount of tariffs he was going to apply to China. So that is probably the biggest risk. FTSE is probably back up, or is back up a bit over 7.3 again by now. But it does seem to be a constant battle. And it's probably the biggest risk to the portfolios. However, if we think about what's likely to happen over the next year, well, of course, we've got a US election. Donald Trump is not going to want to go into that in the middle of a recession because it will almost certainly cost him his job. Equally, with the way that China wants to rebalance their economy, a big trade war is not helpful for that either. So we'll probably see a softening of that over the coming year because it's in their interests as much as anything. So we don't think that that this is going to be a big problem, but the portfolio is a position to try and protect against it if that was the case. So let's have a look at what's been going on. Well, the FTSE 100, as we've just seen on the slightly earlier chart, but this makes it a little bit clearer, has tracked behind in recent months the world index. It's not done quite as well as the rest of the world. But of course, we're not invested just in the FTSE 100, we're invested in a diversified portfolio. And what we can see if we go back 3 years is we can see the performance in green of the diversified portfolio that is level 63 out of 100 on the risk scale compared to the FTSE 100. And what you'll see is what you would expect to see actually from a diversified portfolio. It's why we use this strategy. So when we see a market dip, as we saw here and as we saw here, what we want to see is the diversified portfolio protecting against that dip. Yes, it will fall a bit, but not as much as the market. But when the markets rise, we want to see, we want to be hanging on to the market coattails and essentially do it. So what you will notice is that the biggest gaps open up when there is a market fall. That is the benefit of investing in a diversified portfolio, because it provides that protection in the downtime. It won't stop it falling completely, but it will mean that it falls a lot less than the market. And then when the markets grow, you benefit from that uptick. And that's highlighting that the portfolios are doing exactly what they're supposed to do, I suppose. And this is another way of looking at it. 2018 was the first negative year for the FTSE 100 since the credit crunch. And that's because really the market fell in last quarter as a combination of trade war worries and of Brexit. And what you can see here on this chart is the black line is the FTSE 100 throughout the course of 2018. These blue lines are the different levels of risk from portfolio metrics: 1 out of 100 and 100 out of 100. Even the 100 out of 100 portfolio didn't fall as much as the FTSE 100 and is protected against the fall of that market. And most of our clients aren't anywhere close to 100 on the risk scale. So it is doing what it's supposed to do, which is great. But of course, it all comes back to one saying, which is time in the market is better than time in the market. It's about allowing the market to work its magic. There will be ups and there will be downs. And that's why I said at the start, if you've been invested for less than 3 years, you get too appreciative of the peaks and too worried about the troughs. You just need to let the market work its magic, and that allows you to see the trend of the market and upward rise of the portfolio. So it isn't about trying to time the market. It's much better to put the money into the right strategy and let the market work its magic over time. But of course, investing can be a scary experience. It can be, it is a process of being excited about growth and then worried about losses. And I tried to find a video that best represented what I feel investing in the market was. And the video that I found best is this one coming up now. If it plays. Here we go. So it is a bit of a roller coaster. It is a combination of fear and elation. But anyway, hopefully you can relate to that in some way. So one of the next things that we need to do at the Client Review Workshop is review the performance compared to the other people in the market. Because, of course, it's all very well saying that the performance has been fairly good compared to compared to the market, but if everybody else is getting 2 or 3% more growth per annum than we are, then we need to be moving to those other investment solutions. If we're getting 2% better growth than everybody else, then we should be fairly happy with what's going on, even if the overall returns aren't quite as good as we would have liked. So let's have a look at that. So what we want to do is compare against the discretionary fund managers, which are all the likes of UBS, Coutts, Investec, all of those big investment houses. And we do that through an independent company called ARC. And then we also want to compare against the fund managers out there that run diversified portfolios, people like Fidelity, Jupiter, Invesco Perpetual, Neil Woodford, I suppose. And we want to put everybody in those categories, or those two solutions, both discretionary managers and fund managers, into 4 categories of risk. So the purple line is the discretionary managers, the orange line is the fund managers. And let me just explain what you're seeing with this chart. So this chart looks at the risk compared to the annual return. So up and left is good. In fact, in an ideal world, what we want to see is 14% growth per year with 0 risk. Sadly, that's not possible, but up and left is good. This blue line is portfolio metrics. And this dot here is 1 out of 100 on the risk scale. That's 100 out of 100. That one is 63, that one is 48. So hopefully that gives you an idea of where you are on that risk scale, bearing in mind you looked at your risk score earlier on, hopefully. So what you can say is, and again, if we pick 63 out of 100, because that seems to be that's kind of a common one that we refer to, what we can see is, compared to the discretionary fund managers and the fund managers, and bearing in mind the discretionary managers are supposed to be the best of the best, they're certainly the most expensive solution, and that's typically where you would go if you were investing £10 million or more. But what we've seen is, compared to the discretionary managers, portfolio metrics have been getting roughly 2% per annum better growth after fees than the discretionary fund managers have, which is brilliant. Now this looks at the last 3 years, but if we look at that chart over the last 5 years, we can see something similar. 5 years, even more meaningful data, and we can again see roughly 2% growth per annum, better growth over by portfolio metrics than the average discretionary manager or the average fund manager, which is brilliant to see. If we look at 1 year, it's a little bit more mixed, and I'm going to come on to this in due course, but we can still see for most levels of risk, the performance has been significantly better. For the very highest levels of risk, though, we've probably missed out on a little bit of growth compared to some people, but I think that typically relates to the performance of the US. And I'll come on to that in just a minute, because what we also do every quarter, we redo this performance analysis every quarter so that we can keep our finger on the pulse as to whether portfolio metrics are doing well compared to their competitors or not. And we also do it with 35 leading competitors. Now, I'm not going to show you all 35, but I'm going to go through a few just to give you a few examples. So you'll notice here, this is 7IM. This is Justin Urquhart-Stewart, the guy with red braces on the BBC. That's his discretionary investment management company. So what we can see here is, and if you just remember as we go through these charts, blue is portfolio metrics, red is the competitor, and up and left is good. And what we really want to see ideally is bottom left to top right. I know we're not quite seeing that here, but bottom left to top right is what we should be seeing. So significantly better performance than 7IM. Significantly better performance than Aegon, with the exception of their lowest risk portfolio. Better performance over 3 and 5 years than BlackRock. BlackRock, some weird things going on with their risk management here, but they have had a relatively good 1 year. Brooks Macdonald, again, some crazy things going on with their risk management. And actually, that's probably the most concerning thing, really. Probably the most important thing is that you get the right level of risk that you ask for. And when we see sort of curvy lines like this from Close Brothers, that would really worry me if that was my clients investing in there. Cornelian not doing so well, Fidelity not doing so well, Goldman Sachs not doing so well, except their lower risk portfolio, although that's quite high up for a low risk portfolio. Jupiter have had a really good 1 year, but not so good over 5 years, which of course is more important. M&G not so good, Old Mutual not very good, Quilter Cheviot not very good, Royal London, weird things going on with their risk performance. Scottish Widows not so good, St James's Place not so good, and they're also obviously getting a hounding in the media at the moment about their less than clear charging structure and dodgy practices. But the one that stands out for me, and we've been doing these charts for every quarter for 6 years now. This is the first time where we could look at one company and say, well, actually on a 5-year, a 3-year, and a 1-year basis, these guys look as good, if not slightly better than Portfolio Metrics. Now, 1 in 35 companies and 2 quarters, because this has happened now for the 2 quarters on the trot, 2 quarters in 6 years is not a bad statistic, not a bad ratio. And I think we'd be crazy to leap out of Portfolio Metrics into Vanguard strategy just on this information alone, because it's 2 quarters in 6 years. But it is worth taking a bit of a deeper, more thorough look at it to understand why. Because of course, at any point, the benefit of investing in the way that we do is if, for example, we wanted to switch you out of using Portfolio Metrics and into using Vanguard, we could do so keeping you on the same platform, whether that be Wealth Time Premium, Transact. We could do so for most clients. It would be pretty much cost-free. Well, it would be cost-free only for clients on a certain charging structure would they have to pay something to the platform. And also, it would happen literally in a matter of days. It wouldn't take months to move across as it would do if we were in a traditional discretionary manager. So if we wanted to change it, we could do, but at the moment, my own pension, my own ISAs are still invested in Portfolio Metrics, and we think that that's the right thing to stay with. But let's just look at this Vanguard performance and look at why it's done better. Well, firstly, we can see here is that actually turquoise here is Portfolio Metrics. What we can see here is actually the performance for long periods of time have actually been better than the Vanguard solution. But we saw Vanguard had a stellar 1-year performance compared to Portfolio Metrics, and that's where it's all kind of happened. It's all kind of merged here. And if we look at the split of the investments, what we can see is that the amount of US stocks and shares for the same level of risk is far, far higher. In fact, it's over double the allocation to the US equities. Now, we've already covered the US equities have done extremely well, but whether they continue to do as well as that is probably unlikely, given the number of leading indicators that are suggesting that it's now expensive and potentially heading towards slow growth or even worse, a recession. So firstly, I would say it would be crazy to leap across from Portfolio Metrics to Vanguard now, because I think that we would be making a very rash decision given it's 2 quarters in 6 years. But also I think they've benefited from having a high allocation to US equities, UK gilts and UK index-linked gilts, all of which have done very well relatively over the last 12 months. But it's unlikely that that continues, and I think we'd be buying at the top of the market if we did try and chase down those better returns. So our recommendation is still to stay with Portfolio Metrics. But that's just a chart showing you that how much the US has grown compared to the world index, and it has had very strong growth over the last few years. So if you go back to your review pack, what you'll also notice is a page that shows you your target asset allocation and your current asset allocation. And these should always look fairly similar. They'll never look identical. There'll always be a slight difference, particularly in the cash element, particularly if you're putting money in or taking money out on a monthly basis. The cash element will look a bit higher sometimes, but they should look fairly similar. You've then got a list of the investments that are in your portfolio. But probably the most important chart we can give you is this chart. And that's because it's what we call the above or below the line chart. Everybody always asks us, how much have I put in and how much is it worth? And yet for years, it was the most difficult information to give you because it required technology that could feed this information through. And fortunately, we now have that by working with the likes of Wealth Time and Portfolio Metrics or Premium. And what you're seeing here is a black line that runs through the chart, which is the amount of money you've put in minus any you've had back. So if you're adding money to the portfolio, it'll be going up. If you're taking money out of the portfolio, it'll be going down. Behind it is the value of the investment. So you can always see this, again, this is genuine investment data back to January 2013, so 6 years of data. This is all growth over and above what was put into the portfolio at the start. And so that's what we want to see happening, but of course it takes time for that to happen. Next page in your pack looks at the individual performance of the different accounts you've got, the different PIPs, different ISAs and the like. But actually, and so this is useful if you've got different levels of risk for different accounts or different people, or different investments started at different times, because it shows you the impact of when you started the investment. But probably more helpful is to look at the next page, which is the consolidated performance. So it's the performance that you've got from Portfolio Metrics since starting with them in all accounts. So it's those all accounts are consolidated together. And what you can see here is the performance that you've experienced in over your investment time frame. But what you can also see is the expected growth rate that we told you to expect when we did your efficient financial plan. So what you can, and that's detailed here. So in this example, it's 3% plus inflation, and inflation we assume at the moment is 2.25%. So we told you at the start to expect that level of growth, and that bouncy line is the one that you've actually experienced. A bit more detail is provided down here. Again, it obviously depends on how long you've been investing, but in this example, we would have expected at the outset to have got 34.5% growth, taking into account what inflation has actually been, but we've actually had 48.5% growth, which is fantastic. So this is what we originally based your lifetime cash flow forecasting on, if we did that for you in the efficient financial plan. And this is what you should continue to expect as a long-term growth rate. Obviously, we hope that the Portfolio Metrics continue to outperform this, but this is what we should really be expecting. One of the other things we want to do each year is look at how Portfolio Metrics are doing at picking the underlying funds that they pick. So because for each area, let's pick UK equities as an example, they can choose to put you into a passive fund, which is very low cost, but it only tracks, for example, the FTSE 100. Or they can choose to put you into an active fund, one like maybe a Fidelity fund, where we're paying a fund manager to try and beat the FTSE 100. Now, with your portfolio, you'll typically, if you're in the core approach, which most of our clients are, you'll typically have about 80% active funds, about 20% passive funds. But are you getting value for the fact that within your portfolio, you're paying extra money to the likes of Fidelity and Jupiter to try and beat the market? Well, this blue line shows you the performance after fees of the core approach that most of you are on, and this shows you the performance of the fully passive approach. So these two have exactly this, these two dots have exactly the same investment split, exactly the same percentage in US equity, exactly the same percentage in UK equity. The only difference being these are the active funds that are more expensive, and these are the cheaper passive funds. But as I said, this chart is after costs, after all fees. So what we can see is the active approach is still delivering us somewhere around 1% per annum better growth than the passive approach. So we still recommend that you leave your money in the core active approach. Now, one of the things that we like to do as part of the client review workshop is to have you reassess whether you think the risk level that your portfolio is currently set at is right for the next year and right for the years ahead. And one of the best ways that you can evaluate that is to understand what the different portfolios look like at different risk levels. We can obviously see the performance here. So this is 1 out of 100, this is 100 out of 100, and this looks fantastic, doesn't it? You know, if you knew that this was guaranteed forever, you'd stick it all in the 100 out of 100 portfolio, because we've seen better growth. But of course, it's not guaranteed, and what you'll notice is when the market falls a lot more for the 100 out of 100 portfolio than the 1 portfolio, as you would expect. So if you've got a risk level of 20 out of 100, this would be something along the lines of what your portfolio would look like. So you'd have nearly half in cash and stable assets. You'd have a good third-ish in bonds, so they're loans to companies and loans to governments, so they're considered to be mostly medium to low risk investments, and then about a quarter in stocks and shares. And you'd expect after fees about 1% plus inflation as a return. If we move up to 40 out of 100 on the risk scale, what you can see is we've now got about a quarter in cash and stable assets, bit over a third in bonds, and about a third in, a bit over a third maybe, in stocks and shares. And we can now start to expect about 1.9% plus inflation. If we move up to 60 out of 100 on the risk scale, cash and stable assets has shrunk down to just 4%. Bonds are starting to shrink too, and we've now got close to 2/3 of the portfolio in stocks and shares, and we're now expecting something like 2.74% growth plus inflation. And then finally, at 80 out of 100, all the cash and stable assets has disappeared. We've got starting to have a shrinking, less than a quarter in bonds. We've got global property starting to make a more prominent feature, and the vast majority of the portfolio is in stocks and shares, again, across the world, but we can expect growth of around 3.5% plus inflation. So when you come to think about your risk level, you might want to be thinking, well, okay, what's happening in my life coming up? Am I now deep into retirement and I don't need as much growth, or am I a long way from retirement and I want more, as much growth as possible, and I'm willing to have a more bumpy experience and take a bit more risk with it? Obviously, it depends on what's going through your mind at any one time, and that's why it's worth giving you a bit of an explanation. You can, of course, talk your specific risk level through with your advisor in your one-to-one meeting. So what changes and opportunities are out there? Well, one of the changes and opportunities is the Portfolio Metrics now have fully ethical portfolios available. So that means that you can have portfolios that have been screened of investments into companies like tobacco companies, arms companies, all of those sorts of less than favorable companies. Now, ethical portfolios tend to be higher risk than traditional portfolios because you're reducing the number of investments that can be selected. That can lead to better returns, but it also leads to bigger falls. Now, this isn't an all or nothing decision, and in fact, unless you've got a very large bias towards investing ethically, I probably wouldn't shift everything across to ethical portfolios. But what you can do is do it by account. So you might say, well, I'm going to put my pensions into the ethical portfolio, but my ISAs into the traditional core portfolio. I can show you here the performance of some of the different portfolio metric strategies. The orange one is the ethical portfolio, the green one is the core approach. You can see at this moment in time, the best performance has actually come from the ethical portfolio, but you can also see when the market fell, we've had that was the one that fell the most. That highlights exactly what I have just said in terms of the fact that it is more risky, so you're going to get lower peaks but higher peaks but lower troughs. So that's an option. Again, you're welcome to discuss that with your advisor in your one-to-one meeting, or on your recommendations feedback form following this workshop or webinar. Then you can let us know if you want to make any changes to your portfolio there. One of the key things to bear in mind is your pension allowance. It is far and away the most tax efficient allowance we get given by the revenue and by the government. You can put £40,000 each into your pension each year, unless you earn over £150,000 in total, and it really is worth trying to maximise that allowance, not just because you get income tax relief on it and it grows free of capital gains tax, but also because it's free of inheritance tax. In fact, if you die before 75, it's not only free of income tax, it's also free of inheritance tax, and if you die after 75, whilst your beneficiaries do pay income tax on the money, it's still free of inheritance tax. So it's really valuable from an inheritance tax point of view as well. It's one of the reasons why for our clients in retirement, we tell them to spend the pension last, spend ISAs and general investments and PIPs first, and then come to the pension last. So it really is important that you try and use up that annual allowance for the pension as much as possible. If your earnings are over £40,000 and you haven't been maxing out on your pension in previous years, you can actually use up previous year's allowances that you haven't maximised, and you can use up the previous year's 3 years allowances. So if you've not been putting money into your pensions for the last 4 years. So including this year's allowance, you can put a total of £160,000 in, assuming that you've had a pension set up in the past. So this allowance is really important. You want to really maximise it each year if you possibly can. If you own your own company, you'll be probably aware that they've reduced the dividend allowance to £2,000. So that means that you're now paying more tax on the money that you take out as a business. One way to counteract that is to make company contributions direct to your pension. It's the most tax efficient way of extracting money out of your own limited company, and it can mitigate some of that extra dividend tax. Probably the next most valuable tax allowance is your ISA allowance. It really is powerful to be able to get to retirement having a big chunk of money in pensions and a big chunk of money in ISAs. We've got a few clients where one in particular stands out, where he's been retired now over 7 years. He draws over £100,000 each year in income, and yet he's not paid a penny in income tax since he retired, because we've got money in different tax wrappers, including ISAs and pensions, and we can use those to our advantage and keep his tax to the absolute minimum. If you've got a personal investment portfolio, a PIP as it's known on the WealthTime platform, or a general investment account, GIA as it's known on the other platforms, then one of the things that we'll be writing to you in March to talk about and to enact is the capital gains tax harvesting. So when you've got those specific types of accounts, the growth is subject to capital gains tax, but of course we have our capital gains tax allowance each year, and most people don't use up that tax allowance. So what we want to do is, instead of letting your portfolio grow and grow and grow, and then at some point having this big capital gains tax bill to pay, each year we can trigger gains, and we do that by switching out of, let's say, the Jupiter European Fund and switching into the into the European Passive Fund for 30 days and then switching back. And by doing that, we can trigger the capital gain, and that means we can use up the capital gains tax allowance each year, which means when you come to, when you get stellar growth further down the line, or you encash the whole thing, or whatever it is, you'll have far less tax to pay. So just be aware of that. We'll write to you in March about it, but hopefully that explains. If you've got any questions, ask your client relationship manager, but hopefully that explains why we're doing it. It's a really good thing, but the one thing that we need to know is from you, have you got any other capital gains elsewhere that we don't know about? Because we don't want to be using up an allowance that isn't there, because we'll then create tax, of course. One thing to bear in mind, if you're a business owner or if you've got friends and family that run their own businesses, we can and have been able to for the last few years put your personal life insurance through the business. Now, spending money on life insurance is probably the least fun you can have with your money. So any way that you can cut that cost down and by 30% has got to be a good idea, and that's what Relevant Life Cover does. It just means that it becomes a company expense. It doesn't say you're saving corporation tax, but it's not a benefit in kind. So you can have your personal life insurance through the company as a company expense, but it not create a personal tax charge. So really worth switching any personal life insurance to the business, to Relevant Life Cover, if you or somebody you know has a limited company to be able to do so. If you happen to be changing significant amounts of money either to or from sterling into foreign currencies, we found that the rates that the bank offer are really very poor. So we've introduced a few clients to a company called Money Corp, who have not only been able to get our clients significantly better rates, but they've also been able to advise business clients on when the right time to do it is and whether hedging would be sensible. They've saved our clients quite a significant amount of money. It's probably worth getting in contact if you're transferring more than £10,000 personally, or more than probably £40,000 if you were doing it as a business. But it's worth just sense checking it, because they have proved to be very valuable for the clients that we've referred to them. So again, if you need any help there, an introduction to them, let your client relationship manager know, and we'll be happy to initiate that. Now, if you have a buy-to-let house, a buy-to-let mortgage, there's some tax changes that you probably already aware of, but you really need to be aware of. And that is, you used to be able to offset your mortgage, your buy-to-let mortgage against your rental income, and that's being phased out between now and 2021. So whereas if you took £1,000 in rent and had a £600 a month mortgage contribution, historically you only paid tax on the £400. By 2021, you'll be paying tax on the full £1,000, even though you've got an expense of £600. Combined with higher rates of stamp duty and higher capital gains tax for property than any other asset, it makes buy-to-let investments probably the least tax-efficient investments you can get involved in. And for me, this is what we're starting to see is a number of people trying to get rid of buy-to-let properties. So if you have buy-to-let properties, it may be worth rethinking that, because they're going to become less and less tax efficient. And it's all very well getting 10%, 20% growth, but if you hand all of it to the tax man, it isn't very smart. You're much better off getting your money growing tax efficiently. Again, if you want any help with that, your advisor in your one-to-one meeting will be able to talk you through it and look at what the alternative ways to generate income would be. And one of the benefits of doing the client review workshop each year is that it can act as both a reminder of what we have done and a reminder of what we haven't done. So most of our clients have instigated a trust framework of one form or another, but in my experience, it was the one thing that we used to get asked about each year. Well, remind me, Charlie, why did we do this trust framework, or what's it all about? And then, of course, some clients, particularly when they're in the early stages of their relationship with Efficient Portfolio, they sometimes instigate the financial planning first and then the estate planning second, and it doesn't always happen straight away. So it's worth revisiting what a trust framework does as a bit of a reminder, so that you can be aware of what you've already got or what you haven't got, but you probably should have if you didn't initiate it. And the easiest way to do that is explain about what's wrong with having just a will. And to do that, I'll explain it using my situation. So I'm married to Carol, and we've got two beautiful girls, Fiona and Bronwyn, who are currently 12 and 10. So if something happened to me, just having a will, I'd want to leave everything to Carol and then onto the Fiona and Bronwyn, as you would expect. The problem is that often doesn't end up being the case. So, for example, if I die today, then at some point Carol might get remarried. Let's call him Juan, shall we? So if Carol marries Juan and then was to get divorced, potentially half of Fiona and Bronwyn's inheritance is now gone. She marries Juan and then dies, potentially all of Fiona and Bronwyn's inheritance ends up in Juan's hands. Even if Juan never enters the picture, as and when Carol gets older, if she ends up in a care home, then everything in our estate, including the value of the house, down to the last £23,000, has got to be spent before she gets any help with care fees. And everything in her estate is liable to inheritance tax when she dies. When it moves down to Fiona and Bronwyn, there's continued problems in that at the moment they're 10 and 12. So if we had just a will, the money would go into a trust, but it would all be available to them the day they turned age 18, which would probably lead to an amazing Freshers Week, but not a very good life thereafter. In fact, we might have a couple of Paris Hiltons running around Rutland. Anyway, so there's that worry of them not having a great life, getting the money too early. And then, of course, there's the worry of when they're a bit older, they meet the son-in-law from hell, get married, divorced, then again, half of our hard-earned money could be disappearing off in divorce settlements. And of course, when they want to leave the money to their children, they've got inheritance tax to pay all over again. So how does the trust framework work? Well, the first thing is, on my death, I leave certain assets to the trust immediately. Typically, that will be my pension, my life insurance, my shares in Efficient Portfolio, i.e. my own limited company, and of course, and the first 325,000 of my estate, which typically will be a share of the property. All of those assets are loaned back out to Carol, and she can use them as if they were her own for her entire life. So she can still sell the business, she can still sell the house, she can still spend the investment, she can do whatever she would have done had they been her own money. But sitting in the background is this IOU, which means that if she does marry Juan and get married or get divorced or dies, then actually we've ring-fenced some of the assets to make sure they definitely go down to Fiona and Bronwyn. If she ends up in a care home, because part of the property is not owned by her, we've done the best planning possible to try and protect against the against care fees and against the house being sold for care fees. And also, when Carol dies, we've taken some of the assets outside of the estate for inheritance tax purposes. Now, on Carol's death, she would leave everything else to the trust framework. And that means that as and when Fiona and Bronwyn inherit the money, if, for example, let's say that it was happening today, at 10 and 12, the trustees would be there to oversee that money. And just because they turned age 18, they wouldn't be able to access all of that money. It would be down to when the trustees felt it was right. So if, for example, for one of them, they said, well, actually, you're being very responsible, here's some money to buy a house, then they can do that. But equally, if they're worried about the other one, saying, maybe actually, I think you should only have an income for now because we're worried about how it's going to impact your life, and we don't think that's what Charlie and Carol would have wanted, then they can do that. As and when Fiona and Bronwyn are old enough, they can be appointed as trustees and they can manage the money themselves. But again, it's still best that they take the money out of the trust as an interest-free loan, because that way, if they do meet the son-in-law from hell and get married and divorced, we've managed to ring-fence that asset. And then finally, because when they want to pass the money down to their children, then because it's a loan from the trust, they can return it back to the trust and the grandchildren can take the money out, again as an interest-free loan. And for that generation, we can actually skip inheritance tax on these assets. So between Carol and I and Fiona and Bronwyn, we can save some inheritance tax, but between Carol and I and our grandchildren, we can actually save a huge amount of inheritance tax. So that's the trust framework. If you've already done this stuff, we'll have put it in your review pack. So as a reminder, if we haven't done this stuff for you, we'll be almost certainly putting it in the recommendation section of your review pack. But it's just a question of which trusts form that framework to make the ideal estate plan for your specific situation. So look out for that. One thing that has confused this type of planning a little bit is what's called the residential nil rate band. So this is where the Tory government said that we're going to increase the inheritance tax allowance up to £1 million, and then they made it really complicated, so lots of people don't qualify, as you might expect. So this type of planning still works in line with allowing you to protect the residential nil rate band, but if you have an old will with a will trust in it that was done certainly prior to 2008, then you really need to get that reviewed, because if you have a will with that old type of will trust in, it's probable that it will cost your children more inheritance tax now, because it will mean that they don't qualify for this residential nil rate band. So it's worth getting your will and trust reviewed. Again, your advisor can do that in your one-to-one meeting if you've got an old will with will trust. And while we're on the subject of inheritance tax, most people are always aware of the 7-year rule. If you give capital to somebody, then it takes 7 years to leave the estate for inheritance tax purposes. But they're often not familiar with the fact that gifts out of excess income leave the estate immediately. Now, they do have to be regular gifts, they do have to be out of income, not capital, and they can't affect the standard of living of that person. But if you meet those requirements and you take account of it correctly, then those gifts out of excess income leave their estate immediately. And it's a great way of passing money down to the next generation, whether that be the generation above you passing it down to you, or whether that be you passing it down to your children. Actually, it's worth just coming back to that point. When we look at the trust framework, it's also worth thinking about that from the generation above you. So, for example, if I was again thinking about my situation, if I'm here, I've wanted to make sure that my parents have this type of planning in place, because I want to make sure that as and when, if they do leave us an inheritance, when I want to leave that money onto my children, to Fiona and Bronwyn, we don't have to pay inheritance tax on that money. So it's keeping it outside of my estate for tax purposes so that it can move down to Fiona and Bronwyn in the future more effectively. So if you want us to chat to, for example, your parents about inheritance tax planning and about estate planning and about setting up a trust framework, we're very happy to. Now, that efficient portfolio, the kind of our mission statement is creating a better future through inspirational financial planning. And we want to try and do that in every way we possibly can. And one of the ways that we do that is trying to help clients achieve more of their goals and actually even clarify their goals, because we find that a lot of people aren't very good at clarifying what their specific goals are. You'll remember, if it was in recent years, that when we did your exploration meeting, what we were doing was asking questions to try and tease out what was important to you in the future. And that was forming part of your goals. Because I believe that goals are incredibly powerful in pulling you forward and making your future better than your present. An example of that was actually when I wrote the book, The Dream Retirement. I was at one of my strategic coach workshops, and one of the fellow entrepreneurs that were there announced at this particular workshop that he'd written a book. I said, wow, that's amazing. I could instantly see how that differentiated him from his competitors, how it made him the expert, and I was in awe of this guy because of it. And so, as I did every quarter with my my strategic coach workshop, I was rewriting my goals. I wrote in my 3-year goals to become a published author. I had no idea what I was going to write a book about. I'm dyslexic, so I've never been good with writing. I had no idea how to write a book, but I wrote it on my 3-year goals. And what happened is, over time, I started to think, okay, well, what would the subject be? And started to do some research, and that research gave me the confidence to actually start the process. And then that gave me the courage to actually get it out there, get it published. And in 2015, The Dream Retirement, How to Secure Your Money and Retire Happy was published. And that was just under 3 years from the date that I'd written that down. So writing down goals, even when you have no concept of how you're going to achieve something, is incredibly powerful, because what goals do is they help you break it down. So for that goal, I broke that down and said, well, okay, if I want to have a published book by 3 years, what have I got to do over the next year? Well, that was, over the next year, I've got to have started it, I've got to have a subject, I've probably got to have a working title, and I've started to do a bit of research around how we're going to publish this thing. What have I got to, but then take it back another step. What have I got to do this month? Well, this month, I've probably just got to nail down the subject matter, roughly the area that the book is going to be based on. So goal is something that you can break down into smaller chunks. It's like the old adage, how do you eat an elephant? One bite at a time. So goals are really powerful. And in fact, a week on Saturday, I'm about to take on my first attempt, and hopefully a successful attempt to complete my first Ironman. Just as in case you're not aware what an Ironman is, it's a 2.5 mile swim, it's a 112 mile bike ride, and then after all of that, it's a 26.2 mile run. So it's essentially 3 marathons in a day, but in those 3 different sports. And the reason I'm doing that is because I read a book, funnily enough, again about 3 years ago, and this guy, I was into cycling at the time, but I was looking for I was looking for a new challenge, and this guy was running Ironman. In fact, he tried in the end to complete 7 Ironman in 7 days on 7 different Hawaiian islands. Ended up taking him 10 days, but hey, Rich Roll, still an amazing, amazing achievement. But I wrote on my goals, having read that, to do an Ironman. And I wasn't even really sure that I was ever going to be serious about it. But the only way these things happen is by setting yourself a goal. And so what did I do? Well, 2 years ago, I decided, right, okay, fine, if I'm going to do an Ironman, I better do at least a triathlon. So I did a couple of sprint triathlons, and I did an Olympic distance triathlon. And then by the end of that year, I'd done a half Ironman. Then last year, I sort of consolidated, did some more. I did another half Ironman, a couple of other Olympic distance ones. And then this year, I've been building up to doing Ironman Italy, which is in Cevia, an hour south of Venice on the coast, in a week and a half's time. But it's all been because of setting clear goals and then working backwards from them. So when you're setting goals, you need to set SMART goals. You've probably seen this before. You've got to be specific, measurable, attainable, relevant, and timely. And so one of the things that we try and help you do in the lead up to the exploration meeting, but we want to help you continue to help you do, is to set goals in 6 key areas of your life. So wealth, health, relationships, things to do, things to have. I think I've missed one, but I haven't got it in front of me. I can't remember what I've missed. But so in your follow-up to this meeting, and we might have already sent it to you already, actually, depending on whether you're watching this recorded or not, we will be sending you the Efficient Goal Planner. And what I'd really encourage you to do, we're not going to get on to you if you don't do this. This is not considered as homework, but I'd really encourage you to go through and complete this. And I'd really encourage you to send it back to your financial planner or your client relationship manager. Because if we understand, first, one of the powers of setting goals is accountability, and sharing them with other people gives you accountability. But it also helps us to help try and get you there, because from a financial perspective, using whether it be through tools like lifetime cash flow forecasting or whatever it is, if we understand what's important to you in the future, we've got a much better chance of helping show you how you can achieve it from a financial perspective. So I'd really encourage you to complete that Efficient Goal Planner and also send it back to us prior to your one-to-one meeting with your advisor. Now, I don't know if you've seen the film The Bucket List, a brilliant film with Jack Nicholson and Morgan Freeman, and I'd really encourage you to watch it. Just a really funny but moving film, and it's all about ticking off the bucket list. The things that you must do before you kick the bucket, I suppose. And I want to just spend a few minutes talking about this because of a talk I heard at a conference in Miami earlier on this year. And I looked at the research as to what people's greatest regrets were at the end of their life. So lying on their deathbed, the top 5 regrets people have are that they wish that they'd lived a life that was true to themselves. They wish they hadn't worked quite so hard. They wish they'd let themselves be happier. They wish they'd stayed in touch with friends and family better. And they wish they'd expressed their feelings more. So these are the sorts of things that are worth bearing in mind, because we don't want to get to our deathbed and have these same regrets. Now, at this conference in Miami, I saw this guy, Ben, who's third from the left, doing a talk from the main stage, so in front of 11,000 people, and it was an absolutely brilliant talk. So this young lad was just got to the end of college, and he didn't know where life was going to take him, and he was actually suffering from depression, suffering from anxiety. So these 3 mates of his said, right, we're going to spend the summer trying to do something different. And what they decided to do was they decided to create an amazing bucket list, a bucket list of 100 different things. And this has actually been made into a TV series now by MTV called The Buried Life. But they wrote this bucket list, and there was all sorts of crazy things on there. This wasn't, all of the I want to go to Thailand, I want to go to the Taj Mahal. This was crazy things that they could do over the course of a year. And as an example, the first thing they decided to tick off their bucket list was one of them wanted to be a knight for a day. So they bought this purple bus to go around and live in while they were achieving these things over their summer break. And Ben walks out of the bus in this random US town, dressed as in full knight attire, and he's walking down the street as you would do, which is very slowly, in a knight's uniform or a knight's outfit. And suddenly this kid spots him, and he runs up to the knight, and he kneels in front of him. And Ben said, all I can do now is do what a knight would do, which is, so he took his sword and he touched the young lad's shoulders and knighted him. And this boy got up beaming with happiness. And suddenly another kid came up and he kneeled in front of him. And before he knew it, he'd got a queue of kids lined up waiting to be knighted by him. And a crowd appeared, and then actually the media appeared. And in fact, that day they ticked off 2 things on their bucket list, because not only did they tick off being a knight for a day, they also ticked off being on the front page of a newspaper. Because what they found was, by ticking off something on their own bucket list, they also gave joy to other people. And he went through some principles around why the bucket list was so important. because it's because it's about getting down what's important to you, not just the big things, but it's the little things in life too. It's vital that you write this stuff down, because if you write it down, then it's much more likely to happen. It's then really important about that you talk about it and you share it with other people, because that's when the magic starts to happen. Now, to tick off your bucket list, you need to be persistent. So another example was they wrote on their bucket list that they wanted to play basketball with President Obama. Now, all the guys said, no, that's a completely ridiculous idea. We've absolutely zero chance of playing basketball with President Obama. Actually, at the time, I think they were in Canada. They were like, look, we're not even in the US at the moment. We're never going to be able to play basketball with President Obama. Anyway, they decided to write to a senator, and they got this letter back from the White House saying, great idea, love your enthusiasm, but no. So, not wanting to be knocked back, they found a different senator, went to him. He was higher up in the White House. He wrote a letter into the White House. They got a letter back from the White House that said, great idea, love your enthusiasm, but no. And they tried a third time, and the answer was no. Then a couple of months later, or a month or so later, they got a call saying, look, do you still want to come and play basketball at the White House? President Obama won't be here, but if you want to play basketball on his court at the White House, will that do? And they said, well, yeah, okay, fine, that will do. So off they go, and there's this great video that Ben shows in his TED talk that shows them. They're playing basketball all in jackets and shirts and ties on the court at the White House, and they're kind of absolutely stoked about this, the fact that they're playing basketball on the White House court. And then one of them says, oh my God, turn around. And of course, who walks onto the court but President Obama? And they got to shoot hoops with President Obama. And it was because they were persistent. So you've got to be persistent, and you've got to be audacious. So those are the key things to creating an amazing bucket list. But the final thing that started happening was that they started realizing that actually it was amazingly powerful to help other people tick things off their bucket list. And in fact, and this is the power of sharing bucket lists, because when I wrote the Dream Retirement, I wrote my bucket list, and it was all the bigger things. And once I'd seen Ben's talk, I actually revisited my bucket list, and I added lots more small things that actually would be a brilliant thing to do. And there are all sorts of things, from sending a message in a bottle to playing football at the City ground, because I'm a Nottingham Forest fan, but also sensible, sort of things closer to my heart, like taking a homeless person out for lunch, saving somebody's life, all of these different things. I shared my new bucket list with the team, and Tom Senegals, who some of you'll know as one of our advisors, said, well, I know. So one of my clients is part of a group of people that they have a corporate day where they all play football at City Ground each year. I'll see if I can get you involved. And then another one of my team, Alex Witchley, one of the power planners, said, well, I could organise a lunch for you with a homeless person. And suddenly, because I'd shared things, people were trying to help me. And as a result of doing these client review workshops, what I did was I asked my team to share their bucket list with me. And actually, we've done 2 physical client review workshops so far. First one was attended by Alex Baker, one of our client relationship managers, and the second one was by Stephanie Tannen, our receptionist. And because both of them had shared their bucket list with me, at the first one, Alex Baker had got on her list that she wanted to eat alone in a really nice restaurant. So as a complete surprise to her, I gave her a voucher at that client review workshop to eat in Le Dans Noir, which is not just a very nice restaurant, but you eat in the pitch black, in complete darkness. You don't know what you're eating. So Alex was absolutely chuffed and excited, and also slightly nervous about eating in this completely pitch black restaurant on her own. But because she shared it with me, I decided that it would be a lovely thing to do. And equally, Stephanie, in our workshop on Tuesday, on her bucket list, she wanted to be able to make fresh pasta. So we're sending her on a pasta making course in October, so that she can learn how to and genuinely make some fresh pasta. So all these things happen, and it's happened because people are sharing their bucket list. So in your follow-up to this webinar, we can also send you the efficient bucket list. And what I'd really encourage you to do is watch Ben Nemetin's talk, his TED talk, because it will give you a bit more inspiration, a bit more detail about than I've been able to go into here. We'll send you a list to their bucket list of 100 things, because it's a great way of getting some inspiration to think for things that you can put on your bucket list. But also I'll send you my bucket list as well, so that again you can steal as many of those ideas as you like. So I'd really encourage you to write out your bucket list, but please also send it back to us, and send it back to us prior to your client, your advisor one-to-one meeting. Because if we can identify, for example, if we've got one client that owns a plane and one client wants to learn, to fly a plane, if we can stick those two people together and introduce them, then perhaps some magic will happen and one person will tick off something on their bucket list. So we will try and help you facilitate those bucket list things. We probably won't be sending you to see Petra in Jordan, but if there's anything we can do to help you tick something off your bucket list, whether it be from a financial planning point of view or whether it be from an introduction point of view, we'd love to do that. So please do your bucket list. It's where magic starts to happen. Each year, we at Efficient Portfolio try and raise some money for a really great cause. This year, our chosen charity is the Motor Neurone Disease Association. It's a charity that's very close to our heart, not just because Carol and I lost a close friend of ours a few years ago to this hideous disease, but also because, very sadly, Charlotte, who works for me, has worked for us, Efficient Portfolio, for I think about 8 years now. Very sadly, her mum is going through the late stages of motor neurone disease, and it really is a horrible thing to witness, and a horrible thing to have happen to somebody that you love. So we're trying to raise as much money as we can for motor neurone disease. I am looking for sponsorship for things like my Ironman endeavours. So if you want to sponsor me and you haven't, please let us know. I tend to email my clients, but not the whole business. But any support you can give us there would be really appreciated. We're also doing a charity ball on the 16th of November. There's only a few tickets left for that, but if you'd like to come along to that, please get in touch with your client relationship manager and they'll get that organised for you. And of course, we've had things like the golf day that raises some money as well. So any support you can give us there would be greatly appreciated. We try and email everybody about this, but it never ceases to amaze me that a lot of people don't know that we have a podcast. It's called the Fit Finance Sessions. You can get it on iTunes. You can get it wherever you normally find podcasts. Each session has a different theme. Sometimes I interview a guest. So last month I interviewed an Aussie guy called Peter Graham. Inspirational guy. Used to be a financial advisor. He's now retired. He advises people on retirement. Incredible guy, was terminally ill with cancer a couple of years ago, told he'd got 2 weeks to live. He managed to make it through the 2 weeks to get to the start of his immunotherapy, and is now living life to the full again. He's an incredible guy, and we've had some brilliant feedback from listeners to that podcast. But we've done ones on divorce, we've financial planning around divorce, we've done ones on inheritance tax planning, we've done ones on tax year planning. We've got plenty more to come. So please look out for those, and please give us some feedback if you're enjoying them. Don't forget, we have the Efficient Portfolio Facebook group. That's where we tend to share things, some financial stuff, but a lot of what we call not necessarily financial. So things like Ben Nemetin's TED Talk, we share in Facebook, just interesting things that we find that we think you might enjoy too. So please follow us on that. We're always incredibly grateful when people refer us to other people, other clients. And as a thank you, when they do that, we invite them to what we call the referral dinner, which is a Michelin star dinner. So we do one in London, one in Rutland. This year it was at Hambleton Hall in Rutland and Benares in London. And it's just a really lovely evening where we can say thank you for those people that are kind enough to refer us on to other people, because it really does help the Efficient Portfolio family grow. So if you would like to get an invite to that next year, please just introduce us to people that you think would benefit from our help. As a reminder, if you do, then the benefit your referral gets is they get a free meeting with one of our financial planners. They get a discount off the Efficient Financial Plan fee, and of course they get to bump into you at our client events. And what more could you ask for, or they ask for? In order to make this a bit easier for you, there are a number of ways that you can achieve this. I appreciate it's not always easy to start talking to friends about, have you got your financial planning sorted out? So a few easy ways. We do 3 seminars, one called the Dream Retirement Dinner, one called the Leaving a Legacy Lunch, which is more about inheritance tax planning, and then the Business Planning Breakfast is financial planning for entrepreneurs. So if you know somebody that you think would fit into one of those categories, then please let us know and we'll send them an invite to one of those events. Alternatively, if you would like us to send them a copy of one of our books, like The Dream Retirement, then we'd be very happy to do that. And even if you just want to give them that in person, let us know, we'll send you a copy that you can give to them, because we really do appreciate it when you can refer people in. And obviously, it might be just easier just to say, look, so-and-so wants to speak to you. Can he have a conversation with you, Charlie, or one of the financial planners at Efficient Portfolio, and we'll set up a free call just to discuss with them how we might be able to help. So anything you can do on referrals is really very much appreciated. So we're coming to the end of the client review workshop now. It's time to get your one-to-one advisor meeting booked in. If you want to give us feedback on your review pack as to when you would like that to be, that would be great. It may be that some years you don't need that one-to-one meeting, but just let us know either way. It might be that you've got everything that you need from the recommendations in the pack that we've got done here and from the client review workshop that we've just done now. But if you do want that one-to-one meeting, let us know, and we will, because at least that way we won't be pestering you for a meeting that that you decided you don't need. And we'll get it booked in. And then in your pack, you'll see that you've got your recommendations and your changes. These are the recommendations that we've suggested that you implement to improve your financial planning. They'll all be detailed at the back of your review pack. And if you could return that form to us in the self-addressed envelope, that would be brilliant. That means that when you come to do your one-to-one, well, firstly, it means we can implement the stuff that you immediately want, so we're not waiting for your one-to-one meeting to do that. If it's, for example, using up your ISA allowance, we might as well do it now rather than waiting 6 months. But it also means that if you've got your one-to-one meeting coming up, we can have all the paperwork ready so that you can just sign stuff and get it all organized rather than us having to do it and waste more of your time posting it back to us afterwards. So if you can complete that and send that back to us, we'd be very, very grateful. As that concludes the end of the presentation, I'm gonna leave the chat bot open in case you've got any questions. But before I go into that section, I'd just like to say thank you very much for those that have dialed in and watched this live. If you're watching this recorded, as I say, if you've got any questions afterwards, email your client relationship manager. They'll be more than happy to help. I really hope that you complete your efficient goal planner and your efficient bucket list. And I really hope you get lots of value out of the 5 AM Club. I think it's a brilliant book, and I hope you get some real nuggets from it. If there's anything we can do for you, please don't hesitate to let us know. We're always willing to let you know. I'll just see a few questions coming in. Brilliant, I'll answer those in a second. We're always happy to give you our second opinion on anything to do with money, even if it's to do with travel insurance that we don't actually get involved in. We'd spend a lot of time talking about money. So we're always happy to help where we can. So let us know if you've got any questions, and we will come, we'll try and help in any way we can. So if you could put, I'm going to unmute in case anybody wants to raise the question verbally, or you can put your questions in the chat box. I see Julia's got a few questions, so I think you're probably just typing them, so I'll hang on for those.
Oh, hi, it's Julia here. Can you hear me, Charlie?
Hi, Julia. Hi, Julia.
Great. Hi. Just a quick question about the active versus passive slide.
Okay. Yep.
You know, you were talking about performance, and it was after fees. Is that
yes.
Is that including the efficient portfolio fees as well as the fund manager fees and wealth time fees, or is it?
Right. No. So this chart here is agnostic, regardless of the platform that you're using or the advisor charge that you're paying, because we have different charging tiers for different levels of service. So this chart here is after Portfolio Metrics' charges, and it's after the underlying fund charges, but that chart there is not after our charge or the platform charge, because of course different clients will have different versions of both of those things. So but the importance of this chart is to say, well, okay, because if we, for example, switched you to the fully passive approach, the platform charge would still remain the same, and our charge for your ongoing service would still remain the same. So it doesn't impact this chart at all. All this chart is saying is what's the performance after the investment fees for the fund manager and the discretionary manager, for both the core active and the passive approach. So does that make sense?
Yeah.
Any other questions? Did you have any other questions, Julia?
I think that's it for now. I'll speak to Tom about others. Thank you.
Okay, fantastic. Well, it doesn't look like anybody else has got any other questions. So it just leaves me to say thank you very much for dialing in. I hope it's been valuable. If you've got any further questions, please raise them with your client relationship manager or your advisor at your one-to-one meeting. Have a brilliant end of year, and we'll look forward to seeing you all again soon. Thank you very much.